What if I told you that most people investing right now are walking straight into the same trap that wiped out an entire generation of investors 20 years ago? Back then, everyone thought they were buying freedom. In reality, they were building their own cage, one trade at a time. And here's the shocking part. The warning signs are exactly the same today. AI stocks hitting record valuations, national debt soaring past $35 trillion, and investors using more borrowed money than ever before to buy the dip. It feels like easy money, but that's what it always feels like, right before it isn't. Now imagine this. You spend years chasing the next big stock, riding every wave, and then one quiet morning, the market flips. Suddenly, the portfolio you thought would buy your freedom becomes the thing that traps you. Warren Buffett calls this the emotional death trap of investing. And the truth is, the game hasn't changed, just the names have. In today's video, we're diving into Buffett's most powerful lessons, the ones that made him billions while everyone else was panicking. You'll see how he reads overvalued markets, how he decides what to buy and what to ignore, and how he protects his wealth even when the world loses its mind. Because 2026 won't reward the investors who move fastest. It'll reward the ones who stay rational when everyone else loses control. If you care about freedom, financial or otherwise, you'll want to hear what comes next. All right, let's talk about what's really propping up this market. The market looks strong on paper. AI stocks are soaring, portfolios are in the green, and CNBC headlines are glowing. But under the surface, something's off. The foundation isn't cash, it's credit. Today, more investors than ever are borrowing money to buy stocks. Margin debt, the amount of money borrowed to invest, has exploded beyond historical norms. It's growing faster than the market itself. And if that sounds familiar, it's because we've seen this movie before, in 2000 and again in 2008. It never ends well. But it's not just Wall Street playing this game. It's everyday Americans. Because while tech valuations are flying high, so is the cost of living. Inflation has pushed people to rely on credit cards and personal loans just to keep up with groceries, rent, and gas. We're not just investing with borrowed money, we're living on it. This is what Buffett warned about repeatedly. Never borrow to buy stocks. Why? Because when markets turn, and they always do, debt turns a paper loss into a financial disaster. It doesn't just drain your portfolio. It forces you to sell when you should be holding. And that ruins everything compounding is built on. That's why Buffett's first rule isn't about technical indicators or secret stock picks. It's simple. You're not buying a stock. You're buying a business. If you don't know what that business does, how it makes money, and whether it will survive a downturn, you're not investing. You're just hoping. And in a market built on borrowed optimism, hope is a liability. Now, here's a mindset shift that changed how I invest forever. Imagine you owned a small business. Let's say a local bakery. Every day, your eccentric business partner, Mr. Market, comes in and offers to either buy your half of the business or sell you more of his. Some days, he offers a fair price. Other days, he's irrational, swinging between fear and euphoria. That's the stock market. Buffett calls it the most useful analogy in investing. Why? Because Mr. Market is emotional, unpredictable, and completely uninterested in reality. He offers you prices, but it's up to you to decide whether they make sense. You don't have to react to him. In fact, reacting is where most people go wrong. Right now, the market's volatility index, the VIX, has jumped over 30% in just the last month. That means uncertainty is back in full force. And when the market gets jittery, Mr. Market gets manic. The average investor? They follow his lead, buying at the top, selling at the bottom, and calling it strategy. But not Buffett, and not you if you follow his lead. See, when the noise gets loud, Buffett doesn't look at price first. He looks at the business. He asks, will this company still be relevant in 10 years? Does it sell something people will always need? That's why during market chaos, he leans into what are called defensive stocks, businesses that sell essentials, food, healthcare, energy, utilities. They aren't flashy, but they're built to last. The illusion is that hype equals value. But as Buffett proves time and again, value lives in the boring stuff. And when Mr. Market throws a tantrum, those boring, cash-flowing companies become islands of sanity in a sea of panic. This next one's tricky, and honestly, it's where most people mess up. Every few decades, a new technology hits the market that feels like it's going to change everything. Today, it's AI, just like electricity in the early 1900s, just like the internet in the 90s, just like crypto a few years ago. The hype feels massive, and sometimes justified. Nvidia alone is now worth more than all the major US and Canadian banks combined. Insane, right? But here's the question Buffett would ask. Is this excitement or actual value? See, back in the early 20th century, America saw the rise of the automobile industry. It was obvious the car was going to change everything, and it did. But here's what Buffett pointed out. There were over 2,000 car companies at the start. Almost all of them went to zero. Only 3 survived. So even if you correctly predict a revolution, it doesn't mean you profit from it unless you pick the right companies at the right time for the right price. And most people don't. And that's where Buffett's idea of circle of competence comes in. You don't have to be an expert in every trend. You just have to know where your edge is and stay inside it. If you understand cloud computing, invest there. If you understand logistics or real estate, focus on that. But buying stocks just because they're trending on Reddit or being pumped by influencers, that's not investing, that's guessing. Buffett's approach is boring by design, because boring is what survives. And in 2026, when AI headlines dominate every screen, the smartest move might be the one you don't make, skipping the hype and waiting for clarity. Okay, this is where Buffett's wisdom really kicks in. When you buy a stock in 2026, you're not just picking an asset, you're driving a truck across a bridge. The only question is, how far is the drop if that bridge fails? Warren Buffett calls this the margin of safety, the buffer between what something is worth and what you pay for it. And in a market like today's, where valuations are inflated and investor optimism is sky high, that margin isn't just smart, it's necessary. Let's look at the data. The S&P 500's price-to-earnings ratio, a basic measure of how expensive stocks are compared to their profits, is now sitting above 30. That's nearly 50% higher than its historical average. To return to typical valuation levels, the market would have to drop by nearly half. And then there's the Buffett indicator, a tool he once called the best single measure of market value. It compares the total value of all U.S. stocks to the country's total economic output (GDP). Historically, when the ratio rises far above the economy's actual productivity, a correction follows. Today, that ratio is 69% above the historical average. Let that sink in. We're driving a 9,800-pound truck across a bridge rated for 10,000 pounds. But this time, the drop below isn't 6 inches. It's the Grand Canyon. In bull markets, investors get complacent. They chase trends and assume the bridge will always hold. But history says otherwise. And Buffett's advice is clear. The higher the risk, the more safety you need. That means only buying stocks that are clearly undervalued, with strong fundamentals, and staying away from anything that relies on perfect conditions to survive. Because when the wind picks up, and it will, the flimsy bridges go first. Here's something no one talks about, but it might be the biggest edge. Here's a truth most investors don't want to hear. Doing more doesn't mean earning more. In fact, doing less is often what separates the wealthy from the restless. But in today's world of stock apps, FOMO-driven TikToks, and instant trades, most people confuse motion with progress. Warren Buffett offers a mental trick to break that cycle. It's called the 20 punches rule. Imagine you're only allowed to make 20 investments in your entire life. After that, you're done. No do-overs, no buying back in. What would that change? For most people, everything. You'd stop chasing trends. You'd ignore cocktail party tips. You'd wait patiently for opportunities so obvious they almost feel boring. That's exactly the mindset Buffett credits for his success. Selective, deliberate, high-conviction investing. Now, compare that to what's happening in 2025. Retail investors are pouring into options, day trades, swing trades, you name it. But the data is clear. Over 90% of active traders lose money in the long run. Why? Because the more decisions you make, the more chances you have to get it wrong. And emotions amplify that risk. The most shocking piece of data? It comes from a Fidelity study. They looked at which investor accounts performed best over time. The top performers weren't finance PhDs. They were people who had either forgotten they even had an account or were dead. Let that sink in. The best strategy wasn't speed. It was silence. In a world that tells you to always do something, sometimes the smartest thing you can do is wait. Let's pull it all together. Here's the playbook I'm sticking to in 2026. So where does that leave us in 2026? You've got tech stocks soaring, national debt ballooning, inflation stubbornly high, and a wave of retail speculation that looks a lot like the dot-com era or 2008, maybe worse. But Warren Buffett's strategy hasn't changed in 60 years. And it still works, because it's not built for hype. It's built for survival. Let's recap what he'd tell us today. 1. Buy businesses, not stocks. If you wouldn't be comfortable owning the entire business for 10 years, don't even buy a single share. 2. Ignore Mr. Market. The market is there to serve you, not to instruct you. Be skeptical when prices swing wildly. Stick to fundamentals. 3. Demand a margin of safety, especially now when valuations are high and uncertainty is everywhere. The greater the risk, the more protection you need. 4. Minimize your activity. Invest like you only have 20 shots. Doing less, but doing it right, beats doing more and getting it wrong. If you can internalize just those 4 ideas, you'll be ahead of 90% of investors chasing noise. So how do you build your own framework? Simple. Define your circle of competence and stay inside it. Focus on long-term trends, not short-term noise. Keep cash reserves for opportunities and for peace of mind. Let compounding work in silence. Because in the end, this isn't a game of speed. It's a game of staying in the game. While others burn out, sell low, and wonder what happened, you'll be the one quietly building wealth, brick by brick. Here's the truth, and this is what I remind myself every single time. Warren Buffett didn't get rich by moving fast. He got rich by moving right. He didn't chase hype. He ignored it. He didn't try to time the market. He survived it. And that's the real lesson here. Like, you don't need to beat the market. You need to survive it. Because survival, staying rational, calm, and consistent, is what lets compounding do its quiet magic over time. In 2026, while others are chasing the next hot stock or panicking during the next dip, you'll be holding strong. Not because you're smarter, but because you're prepared. So if you found value in this video and you want more timeless investing insights without the noise, the hype, or the shortcuts that don't work, subscribe to Dividend Hustle. We're here to help you invest with clarity, confidence, and long-term conviction. I'm Mark. Thanks for watching. And remember, you only need 20 punches. Make them count.